Okay, let's get started. First of all, thank you everyone for attending. Very interesting times we're going through at the moment. And I thought still worthwhile talking about tax planning because it's a topic still that's still relevant irrespective of the climate that we're in. And obviously there's been a lot of things that have occurred in the last little while in terms of government stimulus that's also relevant to people. And I just wanted to go through that as well. So I appreciate everyone giving the time to join in. I'm doing this from home. Aintree Group has been working, everyone from Aintree Group has been working from home for the last 4 weeks. And so we've been working remotely from our lounge rooms or our studies, etc. So if you hear any noise in the background, dogs barking or otherwise, that's just because they're probably asking for their dinner or something fairly soon. So I apologise for that. Just in terms of some other housekeeping, so if you have any issues or you want to ask a question, there's a Q&A button, which you can actually up the top or down below, depending on where it's on your screen, where you can actually ask questions. What I'll try and do is I'll try and leave them until the end of the presentation, and then we can talk about it then. But certainly as we go through, if there's something that resonates with you or you want to put a query in, please type it. And then, as I said, at the end of the session, we'll do a Q&A. And I might even open up if people are prepared, have got the ability to speak, they can even ask questions via audio as well. So let's get into it. So first of all, so Tuesday the 19th of May, we'll all remember this year, I think, as a very significant year in terms of the upheaval that the coronavirus has caused us. And irrespective, we're still close to the end of the financial year. We've got 6 weeks to go before the year end. So it's important that we still look at these tax planning measures that we need to consider before year end to try and minimise our tax and also help us through this difficult climate that we're currently in at the moment. This presentation originally was going to be a budget presentation as well as tax planning, but obviously the budget has been deferred. But the government has, as we've seen, thrown a lot of money into the economy in different ways, which we'll cover tonight, to try and help businesses get through. And we want to just go through what the tax consequences of those incentives are as well, so that everyone's clear about how they work, what the tax consequences are, and what you need to look out for in terms of some pitfalls or traps, particularly with the taxation consequences of a couple of them. I'm not going to go into exhaustive detail on them, but I'll summarise them. But then, yeah, we'll just touch on some of the tax consequences for them. So let's get into it. So first of all, and now my screen's not working for me. Here we go. So my general disclaimer. So this is just general advice. So it's not specific to your personal circumstances. Obviously, if you're a client of Aintree Group, we can talk further with you regarding your particular circumstances, but this is just general advice in nature. So if anything in the presentation is relevant to you and you want to discuss it further, by all means, get in contact with us, and then we can give you advice in the context of your personal circumstances. But yeah, just take this as being general advice only at this point. So let's start with the tax rates. So the tax rates for the 2020 financial year are as follows for individuals. They haven't changed since last year. The key thing to note is that they're still relatively high once you get over income of 180,000. So 45% is the tax rate once you earn over 180,000. It's, when we're looking at that comparing to other countries in the OECD, it is relatively high. And there are moves afoot which have been legislated to reduce that tax rate over time or increase the actual tax brackets and the thresholds so that people are paying less tax. The interesting thing will be, based on the circumstances we're in at the moment, and I'll talk about this later, is about whether the government will follow through with some of these tax cuts they're earmarking over the next five years or so. But if your income is less than $18,200, you pay no tax, and then between $18,000 and $37,000, you pay 19% tax, and then you can see the rest of the rates there. If we look at that in comparison to companies, so companies, as a blanket rule, are taxed at 30%, unless, sorry, I've just got a feedback that there's high-pitched noise coming through from my microphone. I'll just try and move some things away if that's causing an issue. Just let me know if that's any better. I'll turn the volume down as well. So I'll keep going. If there's any further issues with that, just let me know. So with the tax rate, so it's 30% for companies across the board, unless your turnover is less than 50 million. So if your turnover is less than 50 million, then your tax rate is 27.5%. So if we compare that back to the previous screen, look at the rates for the individuals, it's below that threshold where the tax rate kicks in at 32.5%, which is $37,000 to $90,000 worth of income. So the company tax rate is lower than that. And that does spurn on tax planning, particularly if you're structured or have companies within your group structure, to be able to get that lower tax rate if you can legitimately. We also can look at, and there's been proposals to reduce that tax rate down to 25% post 30 June 2021. Again, let's wait and see whether that will still actually come through based on the amount of money that the government has spent and the debt that the government has got, and whether they'll actually follow through with those reducers down the track. Superannuation funds, taxed at 15%, a flat rate. That's while you're in what we call accumulation phase. So if you haven't retired yet or met one of the conditions of semi-retirement through what we call the transition to retirement pension or otherwise, the tax rate is 15% on earnings. Once you qualify for a pension and you meet the full pension requirements, then that tax rate can drop significantly from the 15% down to 0, subject to quite a number of rules. The key thing with that one is that 15% is the maximum rate you'll pay. For capital gains, the actual rate, if you've held an asset for more than 12 months, the tax rate on a capital gain is only 10%. So superannuation funds are a low tax vehicle. So again, if we look at that compared to the individual tax rates previously, it's lower than all the rates except for one, which is that first tax-free threshold, which is $18,200. So again, superannuation presents some tax planning opportunities if you can take advantage of them, because the rates in superannuation are lower in general than what you would have in your personal return or through a company. So just looking at general strategies, and as I said, these don't change, even though we're going through difficult times at the moment and people's income might have dropped, we still have to look at and consider these strategies that are available to us, and whether we actually implement it or not is the key thing. And the other thing with it too is that they require cash flow. So with the circumstances at the moment, if cash is tight, then some of these may not be possible because they physically need you to pay or expend the money from a cash flow perspective to be able to claim the tax deduction. So what you can look at doing is consider deferring your income until after 30 June if you expect that your income in the next financial year will be lower. Now, this is particularly relevant in this situation where coronavirus, you might have not seen the full effects of COVID-19, where your income was probably or possibly was strong until the end of March or mid-March, and then it's fallen away or reduced from March through to June. And it might mean, depending on how we go with restrictions and how the economy bounces back from here, it might be that for the next financial year, it might take 4, 6, 8 months before or even longer for you to get back to the types of levels of turnover, if at all, that what you're experiencing before COVID-19 impacted the economy. So looking at ways in which you can defer income to the next financial year are still very important in that respect, because you might be able to push it into a year in which you have a lower tax rate because of circumstances, or secondly, by deferring to the next financial year the income, so your tax is lower this year, that means you've got another deferral on when you have to pay the tax on that income that you're deriving. So that can help from a cash flow point of view. Now, you've got to do it in legitimate means. It can't be just a matter of deliberately changing invoice dates or anything like that. There has to be sound reasons for doing it, but there is still the possibility of deferring income. And generally, depending on how you're structured, you would either be doing it on a cash basis or an accruals basis. So it depends on whether you are taxed on when you invoice or if you're taxed when you receive payment from your clients. That depends on your personal circumstances and is something you should inquire or consult with your accountant on. Similarly, making sure from an expense point of view that you're claiming deductions, you're making sure you're eligible to claim deductions for the current financial year. So one of the key ones, if you're on what we call an accruals basis of accounting, that is that you declare income when you invoice and you claim deductions when you receive an invoice from your supplier. Bad debts is one example where if you've got bad debts, particularly might be relevant in this current climate, you need to make sure you write those off before 30th of June. And what that means is you've got to have taken all reasonable steps to have tried to recover that debt, and you've taken all reasonable steps and there's still no likelihood of you recovering that debt, then you have the ability to write that debt off. We generally encourage you to keep reasonable file notes for that to show that you've taken reasonable steps. That might be including numerous phone calls, emails. It might be that you've engaged a debt collector to try and recover the debt. And also maybe some resolutions of directors' minutes that you've discussed the debt situation with that client and that you've taken all steps you possibly can to try and recover it, but you've been unable to. The benefits of writing it off before 30 June is that you'll get a tax deduction for that before 30 June because you've already declared the income, being the invoice, and therefore if you then write off that debt as bad, then provided it was a revenue item, the invoice, then similarly the bad debt will be an expense which you can claim as a tax deduction. In addition to that, you might also be able to claim the GST on that debt as well, depending on whether you're on a cash or an accruals basis for GST. So it can really help from a tax point of view and also can help from a GST point of view. The next one is to do with superannuation. Whether you're employed or a self-employed person, the key thing is that you need to make sure that you have paid your superannuation contributions to your fund before 30 June and that they have been received by the fund before 30 June. So it's not a matter of just doing an EFT transfer at 8 o'clock on the 30th of June, 8 o'clock at night on the 30th of June, because technically that will be an overnight transaction perhaps, and the super fund will not actually receive that money until 1 July. That means it will not be tax deductible in this current year. And then the other thing you've got to do is make sure you're within the contribution caps, which for the current financial year is 25,000. And that's irrespective of your age. And it's also irrespective of where that contribution has come from. So you might have 2 employers that you've received super contributions for, and you've also made a self-employed contribution or a personal contribution that you're wanting to claim a tax deduction for. You need to combine all those together to ensure that they don't exceed that $25,000 cap. If they do, you could potentially pay excess contributions tax. And the excess contributions tax is not a very tax effective strategy because it is quite high, the rate. The other thing with this too is, and this has been a change that we've noticed in the current financial year, when you're claiming a self-employed contribution as a deduction or a member contribution which you can claim, so a personal contribution which you can claim as a tax deduction, when that is populated into your tax return, there's a box that is required to be ticked that says, have you completed a form to say that you intend to claim a tax deduction for that contribution? Now, ordinarily people will just tick the box, but if that form has not been completed and not sent to your superannuation fund, then the ATO is now doing cross checks with the superannuation funds, and they are actually denying the deduction unless that contribution form has been received by the superannuation fund. So it's very important that when you make a personal contribution or a self-employed contribution that is not coming from your employer, that you nominate that you're intending to claim a tax deduction for that contribution before you lodge your tax return. Otherwise, you will not receive that tax deduction. Generally, the superannuation funds who receive the contributions will send you a notice out in late June, early July. Don't ignore it. You must get it, look at it, fill it out. If you need assistance, contact your accountant so that you can then prepare that appropriately and then send it back to the super fund so that then when you lodge your return, you will not have an issue. We had a couple of instances this year when we were doing 2019 tax returns, when people had said they'd completed the form, we lodged a return, and then we got the assessment back from the ATO and they denied the superannuation deduction. We then had to then follow up with the super fund, fill out a new form, send it back to them, then prepare an amended return. And it just caused a lot of time and effort to be wasted when it should have been done to start with properly. So just be aware of that. And as I said, look out for that form in late June or early July if you've made personal contributions to your superannuation fund. Now, sorry, just checking. Okay, so next one, business income and expenses. So small businesses with turnover less than $10 million can claim expenses prepaid for up to 12 months in advance. For larger businesses, this is generally limited to expenses below $1,000. So what that might be is you prepay your rent. So you're thinking that, look, I want to get my income tax down this year, so I want to prepay 3 months worth of rent. So I want to pay July, August and September rent, but I want to pay that in June. From a tax perspective, if your turnover is less than $10 million, that is an acceptable tax deduction in this current financial year. So it brings forward that tax deduction to you. So if cash flow allows you to do that, then that's something you could consider. Bear in mind, it's just a bring forward. It doesn't give you an additional deduction to the rent you normally pay. It's just bringing forward an expense from next year into the current year. Also, you can look at remunerating spouses or family members. the key thing with that though is it must be reasonable for the work that's performed. So we can't just put a family member on the payroll just because that suits our purposes because they might be on a low tax rate. They actually have to perform services for that income that they're deriving from the business. So just be careful of that, but certainly you are allowed to. You're allowed to pay employees. Pay your family members as employees, provided you can justify the amount that you're paying them. Just got a question here from Sam, thank you. Is salary sacrifice treated as employer contributions or member contributions? It's treated as employer contributions. It's actually called a reportable employer superannuation contribution, and it's shown on your payment summary when you receive it at year end, and you're not required to notify your superannuation fund for those contributions because they're not deemed to be member or self-employed, personal or self-employed contributions. Thank you for that question. Okay, other things to look at. So small businesses planning major purchase or replacement of capital equipment. So there's been some change in rules, which we'll cover in a minute, just about being able to claim tax deductions for purchases up to a certain threshold. And as I said, we'll cover that in a minute. But certainly you've got the ability before 30 June to be able to spend if you need to upgrade computers or if you need a new car for business purposes or whatever it might be, desks or otherwise, probably computer monitors or whatever it might be, then yes, you can claim those up front once you've incurred that expense. So that's another way in terms of bringing forward the tax benefits on those types of purchases. Also, you should look at scrapping obsolete items on your asset register. So if you've got that computer that you're sitting in your asset register from 2012 that you threw away long ago, then if it's got any carrying value left in there, being a value that is not been fully depreciated, then you should be going through and looking at scrapping that asset because you don't have it on hand anymore, and then claiming the balance of the depreciation deduction that's available. So that's just a bit of housekeeping that you should do. So maybe pull out last year's depreciation schedule that we might have sent you, or contact us if you want another copy of it to have a look at what assets are in there, and then go through the process of saying, no, that's been scrapped, I don't have that anymore, it's obsolete, whatever the case may be, and cleaning up that asset register and see if that can allow you to get any further tax deductions. Also, consider delaying the sale of assets if you want to until the next financial year. So if you've got a car that you're looking at selling and it might have an unrealised profit on the sale when you sell it, maybe you could look at deferring that until after 30 June into the next financial year and then pushing that tax issue to the next financial year and then dealing with it then. Also look at revaluing trading stock. So if you're carrying trading stock, look at revaluing that up to 30 June. And then the best practice is generally to value stock at the lower of cost or market value of selling price. So look at that, and you might have some stock, for instance, if you're dealing in fresh foods or otherwise, where there might be perishables or otherwise, again, or looking at, you might carry IT equipment as trading stock, and things change very quickly regarding IT and obsolescence. So looking at your trading stock and actually going and cleaning it up if there's damaged stock as well. Look at cleaning all those things up before 30 June. To value the stock at the lowest price you can, because that will then reduce your taxable income as well. Also, as I said, yeah, this may change if you expect a loss or higher income in the previous. So you've got to look at, sorry, I'm not saying that very well. You've just got to look at the context of what you're doing here versus what you project might be your trading profile and your potential earnings for the next financial year, to then work out whether it's worthwhile pushing income into the next year or bringing forward expenses or whatever the case may be. So it's a matter of looking at these strategies in the context of your business to work out whether they're relevant to you. But they're certainly available for you still. Nothing's changed in this respect. But as I said, some of these require you to be able to manage the cash flow requirements on them, because you might be bringing forward expenses, which means you have to pay for those earlier than what you otherwise would. Just some quick personal ones to look at. So, and these are simple things, and it might be too late to do this now anyway, because you might have locked in a term deposit, but look at deferring term deposit maturity dates until after 1 July. Term deposits work on a cash basis. So whenever the maturity date is and you receive that money, irrespective, even if you're just going to roll that over, the fact is that even if you roll it over, the interest that is assessable at the time when it's rolled over. But if that's after 30 June, then you don't pay the tax on it till after 30 June. And similarly, if that matures before 30 June, then you pay the tax on that income before 30 June. May not be a big deal at the moment. I'm not sure anyone's getting any great returns on their term deposits at the moment. Somewhere between 1 and 1.5% perhaps. If you're doing better than that, then well done. But yeah, at the moment, the rates are fairly low, so that may not have a big impact on you anyway. And secondly, again, if you're locking something away in a term deposit, that's cash flow that you may require during this difficult time. So you just got to factor that in as well. The other thing, looking at realising capital losses, if you've already incurred capital gains during the year. So an example might be where before COVID-19 impacted the share markets, you had some really good results before that. So up till, say, February this year, you might have sold some shares and made some decent capital gains, which you'll have to pay tax on at year end. You might look at your share portfolio and think, oh, yeah, look, some of those shares I could probably let go of, but I don't think they're going to bounce back anytime soon. And you might decide that you want to realise some losses. If you do that, those losses will be able to be offset against the capital gains that you might have incurred pre-COVID-19. So just be mindful of that. So I've just got another question just on super, which I'll quickly answer. Has the legislation to allow individuals 60 to 65 to make personal contributions to super without having to satisfy the work? Good question. I can't answer that one off the top of my head. I'll come back to you on that one. Unless one of the other accountants on the forum want to answer. So this is, if you're over 65, can you make contributions to your fund without having to satisfy the work test? Yeah, as I said, I don't know that at this point. I'll come back to you on that one. Okay, so back to the capital losses. Similarly, the key thing with capital losses too, if you've incurred capital losses during the year, they can carry forward indefinitely. So even if you've got no capital gains and you've got capital losses, then you can use those capital losses in future years. So just be aware of that too. Again, back to what I said before with business, the same rules apply here. If expect lower income in the next financial year, then considering deferring income after 1 July if you can. Because you may be in a lower tax bracket. Those brackets I showed you before at the start of this presentation. So that's just something to think of. And there's some certain rules regarding primary producers that you can take advantage of the averaging rules to be able to help you with that in terms of planning your tax liabilities as well. Donations, that's another thing too. So if you're making donations, you can only claim a tax deduction for donations if you've actually got taxable income and get a tax benefit for it. If you made a loss for the year for any reason, then donations are not deductible. But again, just looking at the timing when you make your donations, to look at it in a higher income year, or if it's a husband and wife and you're looking at making donations, maybe make the donation in the name of the person who's got the higher taxable income, because then you'll get a better tax result. Thank you. Anne from my office has just come back and said the legislation has been delayed regarding contributions for those under 67 due to the COVID legislation. So the answer is no, that's not legislation as yet. Thank you, Anne. Okay, just some other things to go through. Oops, sorry. Okay, common deductions, motor vehicle expenses, home office expenses and uniforms. Now, motor vehicle expenses, one of the lovely or favourite target expenses for the ATO. So key thing with motor vehicle expenses is documentary evidence. So there's a different method you can claim motor vehicle expenses. The two generally applied are the logbook method, where you claim a percentage of your total running costs and depreciation and interest on finance for a motor vehicle at the applicable logbook percentage that you arrive at based on doing a 12-week logbook, or the cents per kilometre basis, where you just say that up to a maximum of 5,000 kilometres, you claim a set rate per kilometre. Now, the ATO is doing lots of work in the area of the set rate per kilometre, where people are just putting in 5,000 kilometres at the set rate and claiming that as a deduction, because that's happening quite extensively through the tax system. So they're looking at that and they're monitoring that at the moment, and they will be asking questions going forward about those for you to justify. And what that really requires you to do is keep documentary evidence, being diary records and otherwise, to justify how you've arrived at the actual number of kilometres you've travelled for the year. So that's really important to do. The other thing too, back to logbooks, is really making sure your logbook is up to date. And we'll touch on this very briefly in the FBT section a bit further, but that is critical. And again, there's a bit of work going on from the ATO's perspective in terms of motor vehicle expenses, and even doing searches through the Vic Roads and other government vehicle registries to actually confirm that you actually own the car you're claiming the tax deductions for. And we had a situation with a client a couple of years ago where they'd registered a car in one of their entities and they didn't let us know about it. And so we weren't claiming any deductions. We weren't even showing it in the records of the client. but the ATO then contact us, say that we've checked the Vic Road records and it shows that this car is owned by this company, and therefore we want you to pay FBT on the car, because irrespective of whether a benefit's been derived or not, because the car is actually shown in the books of the business, it is subject to FBT. So just be mindful of that, both on the context of cars that you may not have advised your accountant for and haven't been recorded in a business entity. And secondly, if you're claiming motor vehicle deductions on a logbook method or otherwise, you must own the car to be able to claim those. So that's very important. Home office expenses, now very relevant at the moment. A lot of people are working from home, such as myself and all of Aintree Group. So the government came out and released some updated or increased the threshold, or sorry, that's not true, increase the amount that you can claim per hour on home office expenses if you're using the set rate per hour. And they've increased it to 80 cents per hour. So if you're working full-time at home, so 40 hours a week or whatever it might be, at 80 cents per hour, that's $32 per week that you can claim as a tax deduction. And that includes all running costs of you working from home. That includes use of electricity, gas, the facilities within your home office, and that's a set amount per hour. And again, requires you to do diary records of the logging the time that you actually spend in the home office, and you do that for a period of 4 weeks, which can then be extrapolated out over the full financial year. So again, it's just not a matter of just randomly picking a figure and putting that in your tax return. You need to, if the ATO queries it, you need to provide documentary evidence to show that you actually have been working from home and able to claim that tax deduction. And the other one is uniforms. Again, these are the target ones from the ATO, because uniforms, again, generally you can claim up to $150 without much substantiation for uniform costs, including laundry, etc. But again, the ATO is very mindful that people are just putting the blanket $150 in per year. And again, if they ask for a further evidence on that, you will need to show records of how you've come up with that $150 per year. The way it works generally is that if you are doing laundry, it's 50 cents per load if it's with other clothing, or if it's just laundry specific to that uniform itself, then it's $1 per load. But again, documentary evidence is important, that if the ATO was to inquire, then you can justify how you've claimed the $150. Some occupational specific deductions, union and professional association fees, then there's self-education costs, agency commissions, agency fees, and practicing certificate fees, and then technical and professional publications. All these things are deductible if you can justify them and show a receipt or an invoice for that cost that's being incurred. And again, particularly with insurances and union fees and things like that, if you've got an annual subscription for those, or an annual payment that you make, and it's coming up to around the 30 June when you make that payment, try and do it before 30 June as opposed to after, then you'll get the tax deduction in the current year. With self-education costs, important that you can justify the nexus between the education costs that you're incurring and your employment to be able to claim that one. And there's been a lot of cases around this one, which are very relevant to, depending on the type of work that you do, to make sure that it is deductible. It can't be something completely secondary to your current earning capacity. Agency commissions and agency fees. So that's, again, if you're incurring a cost where you get invoiced a commission or otherwise, just make sure if you're getting those within around 30 June, getting those before 30 June so you can potentially pay it and claim the tax deduction beforehand. And then technical or personal publications. The Age and the Herald Sun are not technical or personal or professional publications, so generally they will not be deductible. So it's got to be really, again, occupation specific to you. It can't be a general publication. Even the Australian Financial Review generally is not deductible too, because it's not specific to your occupation. So you just got to be mindful of those things when you're claiming those deductions. Other strategies, just quickly. So residency status, if you change, sorry, I've got a question, I'll just, before I go further. Best way to prove that you've been working from home. Look, realistically, just diary records is sufficient. Just if you have a diary next to you, say that I've worked from home from this time to this time. Also helps if you update your calendar to show that as well, that you're working from home that time. That's sufficient. You don't need to go any further than that. So yeah, those records are quite enough. So fine. And then if you need to get some sort of support or otherwise from your employer, you can also, I suppose, request that too. But just diary records will be enough, where you just basically log the day and the hours that you worked at home, in your home office, and that will be sufficient for the ATO. So a quick couple more questions on that, I think. Who can claim home office expenses from my home? It's a person that's actually generally incurring the cost for the home office, so the electricity. So if someone is contributing, so if a daughter is contributing to the upkeep of the house through electricity and other costs, then they would be able to claim it. But generally it's a person who's actually incurring the cost of the home office. We'll keep going. So just in terms of residency status for tax purposes. So if you've changed residency status, this is one thing that's really important from a tax point of view, because it can change your tax-free threshold, or the amount that you can claim under those tax rates that I showed you at the first slide. They were the Australian residency tax rates. But if you become a non-resident, then the tax rates actually change. And what they do is if you change residency during a year, they reduce the tax-free threshold, that 18,200, they reduce that tax-free threshold based on a proportion of the time that you're an Australian resident versus when you're not an Australian resident. So careful consideration needs to be given for that purpose. And then secondly, which we'll come to a little bit later, also has an impact on other taxes such as capital gains tax and how that works, whether you get 50% discounts or qualify for principal residence exemptions, etc. So it does have a big impact if you're changing residency status, both moving from Australia overseas or from overseas to Australia. Secondly, trustees of trust should ensure that they do all the necessary documentation before 30 June. What that I'm leading to with that is if you've got a discretionary trust or even a unit trust, you're meant to nominate how you want to stream the income for that financial year before 30 June. So I'll give you an example. Let's say you've got a family trust who's generated 10,000 worth of income for the year. The trustees have discretion about who they can allocate that profit to for the year, the 10,000. They need to make a nomination of who they want to allocate that profit to prior to 30 June. It can't be done after 30 June, otherwise it might be deemed to be invalid, and the trust itself will pay tax at the top rate of 45%. So this is something we do for all our clients. In the next month or so, you will get those of our clients who've got trust will get a resolution that we've prepared for you, a draft that you need to review and consider, and then sign as in compliance with this requirement to do the distribution resolutions, the profit allocations before 30 June. In addition to that, family trusts may need to make what's called a family trust election. So if you've got a family trust that's got large dividends flowing through it with large franking credits, say from BHP or Commonwealth Bank or whoever it might be, in order to pass those franking credits down to the beneficiaries, you may need to do a family trust election. I'm not going to go into a lot more detail on it. And similarly, if you've got losses within a trust, you may also need to do a family trust election to be able to recoup those losses. It's a fairly technical area of the law, but it's something, again, that you need to consider. And again, as part of our service to our clients who have got discretionary trust, we look at this each year to make sure that we're complying with those requirements. And the last thing I'll say in terms of general strategies is be careful of tax schemes. And, you know, I don't know if you've heard in the news lately, there's been some COVID-19 schemes floating around trying to take advantage of the JobKeeper scheme and other things. My general take on that is that if you are offered or approached or given information on a potential tax minimisation scheme, should always seek our advice before you do anything about it. My take on this always is, if it's too good to be true, it's too good to be true. And therefore there's got to be something wrong with it, or it's a risky, or it's not legitimate investment. So with these types of things that you might come across from time to time, definitely put them past your accountant first to make sure that they're legitimate, and then secondly, whether they suit your circumstances or not. So just be very careful. They're always out there. Like the contact you get from supposedly the ATO, which is not saying that you'll go to jail if you don't pay your tax on time and things like that. Just got to be very diligent about the things that you see regarding tax strategies or tax correspondence to make sure that it is legitimate and it's not a scam in any way. The last thing just on this is to do with capital gains. So just quickly talk to you about, and then looking at things which might be concessionally taxed. So capital gains, if you hold an asset for greater than 12 months, is taxed at only 50%. You reduce the gain by 50%, so only half of it is taxed at your marginal tax rate. So that's something that you need to consider. And then also exempt fringe benefits. So if you're working for a public benevolent society, such as a hospital or a not-for-profit, there are actually fringe benefits tax concessions that may be available to you that can actually mean packaging things through your employer can actually be very effective from a tax point of view. So just look out for those things if they're relevant to your circumstances. And also looking at structures that might attract a concessional rate. We talked before about companies and how their tax rate is generally lower than the individual tax rate once your income is above 37,000. Similarly, trusts have the ability to have discretion in terms of how you allocate income, and superannuation funds, as we talked about before, maximum tax rate of 15%, but could be lower depending on whether you're in accumulation phase or retirement phase. So something to be aware of as well. And again, that's where you should seek advice from your accountant to give further details on how that may be applicable to your circumstances. Now, some other changes that come through. Instant asset write-off. So the government changed the rules to say that if your income aggregate turnover, so general turnover is less than $500 million for the year, and you purchase an asset for less than $150,000 between the 12th of March and the 30th of June, you can claim a tax deduction for that asset in full. So it means you'll get the full tax deduction in the current year. You won't have to depreciate the asset and spread it over a number of years. You'll be able to get the tax deduction in full. The couple of key requirements on that are as follows. One is that the asset must be installed ready for use. So for instance, if you buy a car that you do not get delivery of until July, that will not qualify. Secondly, with a car or any other asset, it must be predominantly used for business purposes. So again, with a car, justifying a logbook of 50% or more. And with cars particularly, you also have to factor in the depreciation cost limit. So even though you can spend up to $150,000 on assets to get an instant write-off, for cars that are subject to the depreciation cost limit, which is running at around $57,400, that's the maximum amount you can claim under the depreciation cost limit. So even if you pay for that lovely Mercedes or Ferrari for $150,000, the maximum deduction you'll get is only $57,400. So just be mindful of that when you're looking at buying assets. And then, as I said before, it's got to be installed, ready for use before 30 June to claim that tax deduction this year. From 1 July this year, now this will potentially change. They'll probably put this through again, but this concession will actually cease. And similarly, this concession that was pre-COVID-19, which is below $30,000 deduction immediately, that will cease on 1 July and will revert back to only being available for small businesses with $10 million or turnover or less, and the threshold will be $1,000. But as I said, I'm anticipating that the government will extend this again, because that's what they've done for the last 2 or 3 years. So that's just how that works. So just be mindful of that again, but a lot of these things, I know you might be able to finance them as well, but some of these things require cash as well. So just be mindful of your cash requirements. And it's a tax deduction. So then you've got to factor in the tax rate that you've got on that tax deduction. There's also offering accelerated depreciation, which I'm not going to go into much detail, but again, if you've got less than $500 million worth of turnover, you can actually accelerate the depreciation on certain new assets. So if it's above $150,000 and you don't write it off immediately, then there's other accelerated depreciation rules that apply, and that's from the 12th of March 2020, and again, it's got to be installed ready for use until 30 June 2021. Okay, let's quickly go through some of the incentives provided by the government to do with COVID-19. I'm not going to go into much detail with these because we could be here for another 3 hours going through them, but and people are probably very familiar with them already because you should have been engaging your accountant on these already. So the cash flow boost is the first one, and that's support for businesses that employ staff. So the requirements are that you have to employ staff and you have to be affected by the economic downturn associated with COVID-19. And there's further eligibility criteria, but basically what that provided was a cash payment to you or an offset against your March activity statement or future activity statements up to September 2020 of between 20 and 100,000, depending on how much PAYG withholding you withheld on your employees' wages. And that's based on what you report in your activity statements. So a lot of clients would have lodged their March BAS and got that cash boost. Some might be still waiting for it. There has been some issues with the ATO, particularly if you haven't lodged your 2019 tax return. There's been some delays, and the ATO is working on it, and they're working through those applications, and there's a number of them, so it'll just take time. But still, just if you haven't received it yet, you just got to be patient. But if you need to follow up with your account, and then they can contact the ATO and get further details on where the progress is with that. but it's basically up to 50,000 for the period from March to June, and then another 50,000 for the period between July and September 2020. Now, the key thing with the cash boost is it's tax-free when received by the business. But there is a catch, which we'll talk about a little bit later. So when you receive that, you don't have to pay tax on the cash boost. It's deemed to be a grant, and the grant is tax-free. JobKeeper, the next one, which is we've spent, Aintree Group as accountants have spent a lot of time on this with our clients, because this is the big one that's provided a lot of relief for our clients. So it's basically, and I'm not going to go into all the detail here, I'm just going to skip through it, but up to $1,500 per fortnight for eligible employees. And again, up till the 27th of September 2020, subject to a review in June. So the government's going to look at this again at the end of June, early July, and then there is a chance that they may change some of the parameters on it, but I don't want to speculate what that might be, but just flagging to you that even though the current legislation says that this is valid until the 27th of September, there may be some modifications for it. So just look out for that. But to be eligible, your turnover must have dropped by 30% if your turnover is less than $1 billion, which should be pretty much everyone in this room if you're running a business. And there's further rules regarding that. The key thing is if you are eligible for it, so it's based on a turnover test, then you need to apply by the 31st of May. If you don't, you will not be in the system. So if you haven't applied yet and you think you may qualify, it's even worth just to chat to your accountant to do some income testing, because it's not just testing March or April. You can even test between April and June to see whether you're eligible, but you must apply before 31st of May. Once you do apply and once you actually qualify through the turnover test and you're enrolled, then you're in the system for the term of the system. So at the moment, until the 27th of September, it doesn't matter if you then don't meet the test in a subsequent month. That's not relevant. Once you're in, because you've met the test, you're in the system for the whole period. And in order to claim your amount that you're eligible for each month, you must lodge a monthly declaration report. So that must be done in a timely manner after each end of month. There's also the Victorian Business Support Fund. So Victorian government providing 10,000 per business, and there's certain eligibility criteria for this one too. So if you look at the list on there, that's the eligibility. The key thing is you must employ people, and that's the theme of all these incentives, is that it's based on you employing people. And this one has a restriction that you must have turnover of more than 75,000, or you have payroll of less and payroll of less than 650,000. I forgot to mention in the slides. I'll just mention it quickly now. Or maybe I did the payroll tax. There's payroll tax relief in Victoria, sorry. If your wages are greater than 650,000, where you get an exemption from payroll tax up until the end of this financial year. But they're the criteria that's available. And they've also just extended the program too. So it was very occupation or business activity specific previously, but then in early May, the government expanded the criteria to say it was open to all businesses who are participating in the JobKeeper program, except for non-employing sole traders. So the key thing with this one is the deadline to apply is the 1st of June 2020. So there's not much time left. There's only less than 2 weeks before this support fund is closed, and you won't be able to apply for it. Just back to superannuation contributions. So this probably answered, or no, probably didn't, but it covers that issue before about whether you're between 65 and 75, 74. You still need to meet that work test at the moment because the legislation's not changed. Just bear with me, I've got a question again. Okay, so is it tax-free? My understanding is yes, it is tax-free because it's a grant again, but I can't categorically, I did try to do some research on this one before this session, so I can't say categorically whether it's tax-free or not, but I believe it is. And were looking at the industry in which you were operating, as in terms of working out whether you qualify or not. They're now not, they're opening up to everyone. So if you qualify for JobKeeper, then in theory, you should be able to apply for this one. When you do the application, they do ask for your business activity statement, and then they do a check on your ABN in terms of what industry you've nominated as your ANZIC code on your ABN to work out whether you're eligible or not. But my understanding now is that it's open to far more people, provided you've got the JobKeeper eligibility, then you should be able to claim this one as well. So back to superannuation. So just quickly, deductions for personal contributions now allowed for individuals under the ages, including those who meet the work test. So yeah, so if you're under 75, you can make personal contributions provided you meet the work test. There is legislation at hand which is saying that legislation which hasn't been passed, which will allow you to set satisfied if you're 65 or 66, as Anne said previously, that hasn't passed through Parliament yet. Quickly, rental properties. Rules changed a couple of years ago. You can't now claim travel expenses to go and inspect your rental property. So if you've got that wonderful rental property in Noosa or wherever it might be, and you need to go and inspect it every year, that is not tax deductible now. That travel cost is not tax deductible. I'll just quick, deductions for depreciation will be limited to the cost of the actual pays for the incurred for the plant and equipment. Yeah, so what that one is, so with rental properties again, it used to be that when you bought a property, you could then carry over the depreciation schedule that you've got from the previous owner of the property and keep claiming depreciation deductions. That has now changed, that you won't be able to do that anymore. So it's only ones that you have actually incurred yourself, not from a previous owner of the property. So that's one to be aware of. COVID-19 relief though, for those who are landlords, if you've had to provide rent relief, you then are to one of your tenants, then you're actually able to reduce your land tax assessment by 25% for the current year. And there's also the ability to defer the actual land tax payment until 31st of March 2021. There's similar incentives in other states as well. So this is Victoria based, but if you look at other states, similar things apply. Just back to super. So maximum cap 25, I talked about that before. You've got to make sure that you don't exceed that cap if you're claiming a tax deduction for it. So that's employer contributions, personal contributions you're claiming a tax deduction for, or salary sacrifice contributions as well. 25,000 is a cap. If you exceed that, there's excess contributions tax that you may need to pay. There's also the ability to do what we call non-concessional or after-tax contributions. There's a cap of 100,000 per year if you're aged between 65 and 74. But if you're under 65, you can actually bring that forward and actually take advantage of 3 years in one payment by using the bring forward rule. So 100,000 times 3, so 300,000. Retirees who are approaching retirement, just got to look at, there's been lots of change in superannuation. I'm going to go into this much detail, but if your member balance exceeds $1.6 million, then there's been changes to the tax rules regarding that. Prior to these rules coming in 1 July 2017, if you're in pension phase, all the earnings on your pension account were tax-free and you didn't pay any tax. Now they've limited that pension account to 1.6 million. So if you've got a member balance that's 3.2 million, then 50% of that will be tax-free, being 1.6, and the other 1.6 million will be taxed at 15%. So just be aware of that. There's also some other tax planning rules around super, but again, we could talk about that for a long time, so I'm just going to skip through it. So just be aware of that. And then there's also some tax exemptions for low income earners, which again, I'm not going to go into too much detail. The key thing is that if you make contributions on behalf of a spouse, you can get some tax benefits as well. And lastly, if you're a high income earner, there's this dreaded Division 293 tax, which means that if your income for surcharge superannuation purposes is higher than 250,000, then you may, instead of paying 15% tax, or the fund paying 15% tax on the contributions received, that increases to 30%. So again, careful planning around if your income's near that 250,000 threshold mark, some careful planning might allow you to avoid that Division 293 tax. They've also changed, based on COVID-19, the minimum pension requirements for the current year and the next financial year. So just showing you, if you're in pension phase in your fund, you're required to withdraw a minimum amount from your pension, from your super fund each year. This just shows you the age brackets and what the minimum amount is, and they've actually halved those rates for the next 2 years. So if you're under 65 and you're accessing a pension from your self-managed super fund as a self-funded retiree, 4% rate has gone down to 2%. So again, that's applicable for the current year and the next financial year. We'll be sending out notice to all our clients that we manage their superannuation funds who are in pension phase, advising of this in the next couple of weeks, so that you can cross-check that with what you've already withdrawn. And then just an example there, which again, everyone's going to get copies of the slides at the end of this. I'm not going to go into that too much detail, but basically, if you've already taken more than the minimum amount based on these adjustments, so if you've already taken more than 2% and you're under 65, you can't, it's bad luck. That money has to remain out of the fund. You can't put it back in to get to the minimum amount. Whatever's taken already is taken, and you can't do anything about it. But yeah, I'm not going to go into the detail of that example at the moment. Just quickly, foreign residents again. This one's an interesting one. If you sell a property for more than $750,000, then you need to fill out a foreign resident CGT withholding declaration form, clearance certificate. This is a silly one, I think, but what the government assumes is you're a non-resident unless you prove otherwise. So irrespective of whether you've been an Australian resident or not even left the country, they deem you to be a non-resident unless you complete this clearance certificate. And what that does is that avoids them withholding 12.5% of the sale price when you when you sell the property or when it goes to settlement. So really important. Generally, your lawyer or your conveyancer will notify you of that when you're selling the property, and you may need to contact us to help us for us to help you complete the certificate. The ATO is very good. They turn them around generally within 48 to 48 hours, so it's very quick. In fact, a lot of them are done instantly. But yeah, it's something that must be done. And then this one is an interesting one too. So if you're a non-resident and you've left Australia and you've got that family home that's you're still holding on to in Australia and you want to sell it now, probably not the best time to sell it, but if you wanted to anyway, from the 12th of December 2019, if you're deemed to be a foreign resident for tax purposes, then you lose the CGT principal residence exemption, unless you satisfy the life events test. And there's some tests, you've got to go through some criteria on that. I'm not going to go into it at the moment, but it's another one that's a fairly significant change that people need to be aware of. But quickly, FBT, if you provide fringe benefits to employees, then you need to take into consideration fringe benefits tax. The tax rate is horrendous. It's 47%, and it's something that you would want to try and avoid as much as possible. Key thing is make sure you use the logbook for motor vehicles, as I said before. Really important to make sure that that logbook percentage is maximised. And also, if there's other benefits that have been provided, you need to make sure you keep the appropriate documentary evidence. For instance, you might provide, I'm trying to think what one might be. You might provide a laptop to an employee. And what you need to do is sign a declaration to say that that laptop is used for business purposes and therefore it's not subject to FBT. So making sure your documentation is in place for that. If you are subject to FBT and have to lodge an FBT return, then the due date for that return is now the 25th of June 2020 for March 31. So it's not ready yet, not due yet, but will be due soon. So if that applies to you, then you need to, we would have sent out to you if you're a client of ours and you're subject to FBT, an FBT pack with a questionnaire and relevant declarations for you to sign. You need to get those back to us soon if you haven't already, so we can get that tax return done that FBT return done for you. Just some other COVID-19 implications. So ATO deferrals. The ATO is providing the ability to defer BAS payments at the moment. So they're trying to assist people with cash flow. So if that's relevant to you, then contact us and we can assist you with it. Also, you've got the ability to change the GST reporting method from quarterly to monthly if you're in refund situations, so you can get those refunds earlier. And you're also allowed to vary your March PAYG instalment, and it might not be too late if you haven't lodged your BAS yet. You can lodge your PAYG instalments, which is your company tax instalments or personal tax instalments, to zero in the March quarter. And then you also then able to claw back any instalments you might have made for September and December as well. The key thing with those ones is you just got to be careful, because that's just giving you a refund now, but then you've obviously that's a deferral, or you've got to then pay that tax when you lodge your tax return. So you just got to factor that into your cash flow, that it might help you now, but then you've got to factor in that when you lodge your tax return at year end, you might have that liability then. So you've got to make sure you've got that money put away for when that is due. And then lastly, the ATO is being very cooperative at the moment, and allowing interest and penalties to be remitted or reversed for post 23rd of January 2020 if you've got outstanding tax liabilities with the ATO. So important to get in contact with us if you need assistance with these, where we can help you to navigate these and get the best result for you. Sorry, here's payroll tax, I forgot about it. So again, Victoria, some payroll tax benefits. If your taxable wage is less than $3 million, then you have the ability to request a refund for your existing payroll tax you might have paid during the financial year, and then that's because you're not applicable, payroll tax is not applicable for this financial year for you. So that's quite a significant benefit. Most people would have already applied for that and got their refunds already, but that certainly is a good little thing to take advantage of. So if you haven't already, you need to get onto that straight away. But having said that, even though there's no assessment if your wages are less than $3 million, you're still required to report monthly or quarterly, whatever the case may be. It's just that there'll be no actual tax assessment on those monthly reports. You can also then defer. They're giving the ability to defer the payroll tax for the first quarter of the 2021 financial year, so it's the September quarter. So that's important too. And then there's also some other incentives as well. Just to let you know that these JobKeeper payments, if it's for people who have been stood down and they're actually not working for you but are still employed by you, but they're getting JobKeeper, those payments will be exempt from from payroll tax. They'll also be exempt from work cover. Similar things apply in different states, but the thresholds and the rates, etc., are different. But certainly one to look out for if you haven't done it already. Now, some hidden stingers, just some quick ones. So cash flow boost. So as we talked about before, there's certain eligibility criteria you have to meet. So not all businesses are eligible for the cash flow boost. So if you don't employ people, then you don't qualify because you haven't withheld PAYG withholding, and you don't have any employees on your books, and that's what it's all geared around. So if you employ contractors and not employees, then you may miss out. Also, business structures. So depending on which business structure you operate through, similarly, you may not qualify if you don't employ. So if the owners, for instance, are operating through a company and you pay yourself via dividends as opposed to a wage and therefore are not employed, then you will not qualify for the cash boost because there's been no PAYG withheld. The other thing with it too is that the cash flow boost, as we talked about, is tax-free, but depending on how you're structured, it actually may not be tax-free. And I've got an example which is quite detailed, and I'll quickly try and summarize it for you. And I've put into the columns a company, unit trust, discretionary trust, and sole trader. The long and the short of it is, with a company, even though it's tax-free income, if you want to get that money out of the business as a dividend, that dividend becomes taxable because it hasn't had any tax paid on, therefore it doesn't have any franking credits. So if you work through these examples and look at the bottom, and again, you can look at these in more detail down the track. If we're assuming that the person or the entity has got 50,000 worth of cash boost and then 50,000 worth of other taxable income, so their total income is 100,000 in each scenario, down the bottom, you'll see the total tax payable depending on which structure you've got, on the basis that all the profits that you've been derived, and particularly the cash boost, has then been taken out of the business as a dividend or a distribution. And you can see that the effective tax rate for a company is 25.72%. So you actually pay tax of $25,717 on the full 100,000 that you've received, being cash boost plus other taxable income. With a unit trust, that's down to 16,342. For a discretionary trust, it's 7,467. And for a sole trader, it's 7,467. But that's on the basis that you qualify for the cash boost. So for a sole trader, if you don't employ, you don't qualify. Similarly for the other entities as well. But this is on the basis that you do meet the criteria for the cash boost and you've received the cash boost. So depending on which structure you're operating through, the cash boost is actually not tax-free. So for companies and unit trusts, there is a portion that you'll pay tax on that cash boost at the effective rate in these situations, 25% and 16% accordingly. So it's just something to be aware of. JobKeeper payments. Again, not all businesses are eligible for JobKeeper because again, it's based on you employing. So again, if you use contractors, then you won't qualify unless you've got employees. Similarly with the business owners, again, if you take your profits out of the business as a profit distribution, such as through a trust or a dividend through a company and don't pay yourself a salary, then only one business owner will be eligible. So if it's a husband and wife or there's multiple directors on a company, then only one of those people, if they're not receiving a salary, will qualify. So it discriminates between those businesses that take out their profits in the form of dividends or profit distributions as opposed to salary. So just very important to note. JobKeeper payments are taxable, so they don't have the same impact that the cash boost does, but they are just assessable income to the recipient receiving that, being the business. So company, trust, sole trader, they'll show this as assessable income in their business activity statement and in their tax return. No GST on it, but we'll show it as income for their tax return. Careful for employees to, one thing that employees to note, particularly if you're on Centrelink benefits, that if you receive the JobKeeper payment, even if you stood down, you're receiving $1,500, and that might be more than what you normally receive as income, then that is treated as income for the purpose of Centrelink. So it may impact Centrelink payments such as family tax benefit, age pension, and New Start allowance. So just got to be very careful if you're the recipient of that it won't affect those pensions. Now, obviously, the JobKeeper is for a short-term period. It's only until September. And then after that, you may not receive that income if you're on a lower rate, if you're working part-time or as a casual or otherwise. But during this period, it will impact your other entitlements, and you need to be on the front foot, and you need to notify Centrelink of that circumstance. And as I said, touched on briefly before, the JobKeeper payment will be subject to a government review at the end of this financial year, so end of June, early July. So what changes will be made? If the economy is back up and running, they may actually tinker with the time frame. They may actually shorten the time frame. Who knows? I don't want to speculate too much more than that because I've got absolutely no idea. But they have said that they're going to review it. And part of the reason why they're going to do that too is because the uptake on it has been higher than what they anticipated. They were estimating up to 6 million employees would be on the JobKeeper. And as of last week, I think they're at 6.1, and there might be further people that businesses that register and apply for it in May, which will increase that threshold even further. So therefore, there'll be additional outlays the government will need to make under this program, which is a $130 billion program. It may cost them more money, and therefore they may want to look at ways in which they can reduce that additional cost that they might have to incur. So let's watch this space and see what happens in late June, early July. And then my last comments on this one is that there's obviously going to be a large amount of debt that's going to be created by the stimulus package. So as I said, $130 billion just in the JobKeeper, plus then the cash boost is another substantial, I don't know how much it is, but I think they're talking that potentially that the government debt could exceed $1 trillion at the end of all this. So my question, which is purely a question, and again, it's speculation, none of this is actual factual, it's just my commentary on it, is the government at some point will want to start trying to reel in this debt and they want it repaid. So how are they going to do that? So things to consider potentially would be, maybe they'll look at increasing the rate of GST. Maybe they'll revisit some of the policy that the Labor government were earmarking at the last election regarding needed gearing of franking credits or capital gains tax changes. Will they look at increasing the age pension eligibility age from currently what it is up to a high rate? I think it's moving towards 68. It might even go to 70 or otherwise. Will they further tinker with superannuation? Or will they defer these future company and personal income tax cuts? Who knows? But we're definitely in interesting times, and it's all about us doing what we can at this point to minimise our tax and get through this difficult time. But then, yeah, us as a nation will have to deal with the fallout of this and how we're going to repay it going forward. So, yeah, it'd be interesting to see what happens in the coming months. Probably not much will be spoken about this until after at least September, October, maybe not wait till the end of next year, next calendar year. But I'm certain there's got to be some change that will have to be put in place so that so the government can repay some of this debt. That's it. So I've gone through a lot in quite a lot of detail, but very quickly as well. And I've tried to answer as many questions as I could along the way, which I think I've done most of them. But yeah, if you've got any further questions for me, please let me know in the questions and answer section. If you want to discuss any of these things in further detail, in more detail, then please contact your accountant, whether it be myself, Graham, Ashley, or any of the other accountants in Aintree Group or bookkeepers in Aintree Group, where we can give you further information on any of these matters. We will be doing some tax planning with clients before 30 June on top of this anyway. Just giving you further information on these things, but certainly irrespective of the climate, excuse me, the climate that we're in, it's really important that you consider these things and wherever possible, try and implement things that are relevant to your business to try and reduce your tax as much as you can, because with some of these things, if you don't do it before 30 June and you've got the ability to, then that benefit might be lost forever. So don't miss the opportunity if it's there for you, but similarly, be mindful of your cash flow requirements in this uncertain time that we're in at the moment, and make sure that you're not then going to be putting an undue strain on your cash flow and your business resources to be able to get through this difficult time. So that is it from me. I hope you enjoyed the session. I must say I prefer it when we're actually in the room together, where we can actually interact a bit better and put a face to the comments and everything. But I'd like to thank you for being part of this session tonight. And yeah, and hopefully everyone's keeping safe, and fingers crossed that the economy, I know we're starting to ease restrictions at the moment, and the economy will start to bounce back fairly soon, so we can all get back on to some form of normality in the near future. So again, thank you for your time, and all the best.